Hey, thanks for joining us on this second recording about the financing. We talked before about no financing at all. We talked about an option of purchase agreement and a sale and purchase agreement and just flipping those contracts. Well, we're going to talk about using the existing financing. Let's say this is currently a first mortgage or a first and second mortgage. So that's what this recording is going to be all about, using the existing financing. All right. Structuring deals around the existing financing. The second category, how do we use the existing financing? We're going to show you how that seller is going to help you solve their problems and give you their debt relief either by taking over their loan, which we call a subject to existing financing or a subject to, or structuring an agreement that allows you to make their payment for them on their underlying liens. This does not mean you're going to formally assuming these loans from the sellers. There's no qualifying to assume loans. As a real estate investor, it's not necessary for you to formally qualify to assume loans. Besides, many mortgages are not formally assumable. That went out a while ago. And the credit criteria required to assume a loan is the same as if you go out and get a new loan. It's not easier. Also, you don't need to put any of your personal credit on the line to do deals when you use structuring these deals around the existing financing. Here's the first way, buying subject to. Subject to. One way to structure a deal is around the existing financing. It's to take over the property subject to existing loan. If you don't know what subject to is, look at a HUD-1. You'll see on the lines, we are buying the property subject to existing financing. It's right on the HUD-1. The seller is willing to deed you their house if you agree to make the payments on their loan. There are many sellers out there who are facing foreclosure and are willing to deed you their house if you can save them from being foreclosed on. This way, the seller's credit is saved, which means a lot to them. In other cases, the seller may not care about their credit rating, but they still will deed you the house if you're willing to give them some moving money. Okay? Now, there's no credit involved with this when you take a property subject to existing financing. You're not formally assuming the loan. You're just promising to pay. Therefore, you're not going to be using your credit to do the deal. Also, your name does not appear on any bank's documents, and you're not personally liable for the bank for payments on a note that you took over subject to. But realize you have a moral obligation, a moral obligation. Now, there's little or no money required. The only money you're going to need would be for making up past due payments that the sellers didn't make. You also might agree to give the seller some moving money as part of the deal. From then on, the only money you should need would be for any repairs, cleanup, and of course the monthly payments on the seller's loan. Now, there's very little closing costs when you buy a property subject to. The only closing costs you're going to have is for recording the deed, and we're going to cover how to draw up your own quitclaim deed when we go through agreements for subject to. And there's no need to have a formal closing at a title company. You can simply have the deed notarized and then go down to your courthouse and have it recorded. In addition to paying a recording fee on the deed, some states may require you to pay a transfer tax. But that's about it. It's very, very minor. When taking over a property, it would be in your best interest to at least have the title checked. Do a preliminary title check, which will cost you a couple $100s. You can get title insurance on a property you took subject to, but you may find a few title companies won't write you a title policy. Usually, a title company will make an exclusion in the policy stating that the policy's title still has to have a mortgage against it. Realize just because a seller transfers the title does not mean the loan goes away. The loan remains as a lien against the property in the seller's name until the lien is paid off or assumed. Until then, you're going to be making the payments on behalf of the seller. Now, claiming the tax benefits. The interest on the payments that you make are even tax deductible, and you don't need interest statement from the lender to be able to claim it on your tax return. Just because the tax statement the lender sends to the IRS is in the old owner's name does not mean you can't claim it on your own tax return. If you get audited, all you have to do is produce copies of the checks where you were the one who paid that interest, making the mortgage payments. Now, to make these mortgage payments, the only thing you're going to need to do is to mail your check into the lender. You don't have to ask their permission to send them money on behalf of the seller. If you send them money for a payment, they will take it, no questions asked. When the bank receives the payment, they're going to send it to their data entry department, and they enter in this loan number that you write on the memo area of the check. Make sure you write the loan number in the memo area of the check and the dollar amount paid into their database. The person doing this data entry goes from one check to the next, one right after the other. When entering in each payment, they don't look up the account by the name. They look at it up by the loan number. By the way, do not try to change how puts their property into a land trust for estate planning purposes. That's an exception. Furthermore, the Garn Saint-Germain does not just apply to owner-occupied properties. The law simply says that it applies to single-family residences, and because it's a federal law, it applies to all 50 states. Now, we can give you a copy of this law. The specific paragraph we're referring to is paragraph D8 in the exhibit, which reads as follows. Quote, a transfer into an inter vivos trust in which the borrower is and remains a beneficiary and which does not relate to a transfer of rights of occupancy in the property. When necessary, some investors have the seller put the property into a land trust with the seller as the beneficiary. And this is covered under the Garn Saint-Germain Act because it's a transfer into an inter vivos trust and the transaction does not relate to the rights to occupancy in the property. The seller then assigns their interest in the trust to the investor. This does give rise to the due on sale clause. However, this is done on a separate document that is not required by law to be recorded in the county courthouse. Furthermore, usually the only person to have a copy of the transfer document are the seller and the investor. Now, if the lender sees that there's a transfer into a trust, they may ask for a copy of the trust for their files, usually by sending you a letter. Now, if the lender does ask for this, simply ignore the letter and see if they send you a second one. If the lender still wants to push the issue, you can simply mail them a copy of the land trust showing that the original owner is a beneficiary in compliance with the Garn Saint-Germain Act. Of course, you want to conveniently forget to include the copy of the assignment of beneficial interest. We're going to cover this more later in the land trust section. Now, will lenders call a loan due? This is so important, so important. Most banks won't cause you a problem even if they did somehow realize that you took over the property. Banks already have enough problems with loans that are in default right now. They don't want to create more defaulted loans by calling loans due which are paid up to date. Banks would rather have the money than have the house because the house becomes a liability on their books and even affects how much money the government will allow them to lend out on new loans. This is not to say that banks never exercise due on sale clause, but it's extremely rare. Okay? If the seller has an equity line of credit, one circumstance in which a lender will call the loan due almost 100% of the time is when a seller has an open equity line of credit on the property. It's because the seller could go down and borrow some money against the property which they are no longer own. So if the seller has a credit line on the property, do not purchase it until that credit line is closed. Let me repeat that. Do not purchase it until that credit line is closed. You can find out if a seller has a credit line simply by asking them. In case the seller doesn't tell the truth, any open credit lines will still show up in a title search. Now, what if the bank tries to call the loan due? There's always that slim chance that the lender will call the loan due or at least pressure you to qualify to assume the loan. if they figure out you took over the property subject to existing financing. If the bank tries to call the loan due or tells you that you have to pay it off or qualify to assume the loan, you can tell them that you are not going to do it. You can even point out that you have not signed any paperwork which says that you pay off the loan or qualify to assume it. If you bailed the original owner out of foreclosure, you'll also want to point out to the bank that at the time you took over the property, the original borrower was several months behind. To help discourage the bank from calling the loan due, you can further tell that the property is in poor condition, and if they call the loan due, you're going to abandon the property. Also, you cannot guarantee what the condition of the property will be in when the bank gets it back because the neighborhood is subject to random vandalism. Furthermore, you can let the lender know that you will continue to mail in the payments and they can either cash the checks or take the house back. That is, whatever house may be left by the time they get it back. It sounds like scare tactics, but it does work. The bank may think you're implying you're going to do some of the property, but that is fine. However, you're not really going to vandalize the property, but the statement is true. If the lender is going to call the loan due, you're not going to continue maintaining and watching over a property that you no longer own. You also not truly guarantee the property will not be vandalized. There's no way to guarantee that. The bank can draw their own conclusion about this statement. If they're going to play hardball back. Some banks may be just too stupid to realize that you're going to be doing them a favor by making the seller's payment for them. By the way, if the bank calls the loan due and actually files for foreclosure, which rarely happens, the foreclosure will not show up on your credit because you never signed on the note as a borrower. Also, most money you can lose is whatever you have invested. This shouldn't be very much if you got a good deal. If you're not willing to risk that, then don't do subject to at all. Don't do it. You may want to look more heavily at using lease options instead of subject to. It may be to your psychological benefit to go to your local investor association and talk with some real estate investors that have taken over houses subject to that have due on sale clauses. Most, if not all of them, probably tell you they never had any problem. So that ends the subject to conversation about using the existing financing. Now we're going to go quickly through some less complicated ones, such as wraparound mortgages or contracts for deed or land contracts or agreements for deed and lease options. So let's start now about wraparound mortgages. What is a wraparound mortgage? You know, some people are very confused about a wraparound mortgage. Okay, in this scenario, the seller's willing to deed you the house and not worried about the due on sale clause. If there's an existing financing, it's going to give rise to the due on sale clause. Realize we're not talking about a second mortgage for the remaining balance of the sale after you subtract the first mortgage from the sales price. We're talking about a mortgage for the entire sales price. We're going to give you an example. Let's say you're buying a house for $200,000 and the seller owes $160,000 to the bank. You're going to give a seller a wraparound mortgage for $200,000, the full sales price. You can make payments on your $200,000 loan to the seller, and the seller is making their payments on the underlying $160,000 to their bank. See, the $200,000 mortgage that you give the seller wraps around the seller's existing $160,000. This is also conferred to as an AITD, or an all-inclusive mortgage, or an all-inclusive trust deed. It is different from a seller-held mortgage in which you give the seller a $40,000 mortgage and then make payments to the seller for the $40,000 while making a separate payment for the $160,000. So that's a wraparound mortgage. Next one is agreement for deed, land contract, contract for deed, contract for bond in Louisiana, contract for sale in California. Agreement for deed. The next technique we're going to discuss, which can be structured around the seller's existing financing, is agreement for deed or contract for deed. land contract, installment sales contract. Under an agreement for deed, the seller agrees to make installment payments on the property, but they don't get the deed. The seller agrees that once the buyer is paid for the property, they're going to deliver a deed to the buyer. This is basically the same as seller financing or a mortgage, except for the fact that the buyer does not receive title until later. Now, the seller could also agree to convert the agreement for deed into a mortgage after a certain number of installment payments have been made, but before the entire purchase price has been paid off. This gives the seller a chance to test drive this buyer before transferring title and giving them a mortgage. Now, when you buy on agreement for deed or contract for deed or land contract, this is a form of seller financing. There's no credit required. You don't need any credit unless the seller specifically asks to see your credit report. Now, there's little or no money required. The only money that you will need is whatever the seller requires as a down payment. And the closing costs, your upfront closing costs will be minimal because most of them will come later when you fulfill the terms of the agreement and the seller transfers the title. Even then, your portion of the closing costs can many times be rolled right into your loan, which means they won't have to come out of your pocket as the buyer. Some states do require an agreement for deed to be recorded for the agreement to be valid. And if this is the case in your state, you're going to have to pay a few bucks up front to record the agreement. Even if your state doesn't require it to be recorded to be valid, you still want to record that agreement for deed just so you know that your interests are secured against the property and that property has a clouded title. You should also pay a few dollars to get a quick title search done to make sure that whoever owns that property you're buying, that title is clear. Now we're going to get involved. The next section is lease options. Very, very popular way to buy a property or control a property by structuring the deal around the existing financing, doing a lease option. This is because lease options have so many benefits to both the buyer and the seller. Now, if you're buying, there's little or no money required. First, you can take control of the property using very little or even no money. Most of the time, any money you put down would be about the same as a security deposit on a regular rental lease. This is assuming you're not bailing the seller out of a foreclosure in which they might be several months behind on their mortgage. There's no credit required. Again, this is a form of seller financing. You don't need any credit unless the seller specifically asks to see your credit report. Closing costs. Another great thing about lease options, there's no upfront closing costs. This is mainly due to the fact that the closing does not take place until you exercise your option to buy. Now, before we talked about agreement for deed and contract for deed, you can sometimes refinance the agreement on a lease option and roll your closing costs right into the loan. If you happen to be subleasing optioning the property like a sandwich, whatever closing costs your seller does not pay can be passed on to your tenant buyer. Now, what's the difference between a lease with an option and a lease purchase? Now, there's very distinctive differences between lease options and other financing techniques that you should understand. So the difference between a lease option and lease purchase, a lease option says you have the option or the choice to buy the property. It's a right to buy the property, but you don't have to buy the property. And a lease purchase says that you are buying it, but you're leasing it first. The main difference is that with a lease option, you do not have to buy the property if you decide not to exercise your option. Under a lease purchase agreement, you're agreeing right from that get-go that you're purchasing the property, and in general, you sign a sale and purchase agreement with all the terms, and it's like a delayed sale and purchase agreement, but you're leasing it for a little while first. So a lease purchase agreement, you're agreeing right from the start that you are purchasing the property. This means that a lease purchase is almost identical to an agreement for deed because it's an installment sale. On the other hand, a lease option is very different from an agreement for deed. So what's the difference between a lease option and an agreement for deed? As we just stated, this lease option gives you the choice or the option to buy. This option does not state that you are buying or have to buy. It just states that you have the option of buying if and when you're ready. An agreement for deed says that you as the buyer are buying and you're going to get title to that property after you meet the terms of the agreement. Thus, an agreement for deed is an installment sale. Many people argue that a lease option agreement is also an installment sale if the tenant buyer is getting a monthly rent credit toward the purchase price of the house. The main difference is that under a lease option agreement, the rent credits only apply after the tenant buyer exercises their option. Also, the tenant buyer only has an option to buy. Until this option is exercised, there is technically no active agreement for sale. Also, the seller under a lease option does not have to file foreclosure like it would if it was sold under a contract for deed or agreement for deed or land contract. This is especially important if you plan to be the seller. Okay, we're going to stop here. The next recording, we're going to talk about our investments that require new financing. New financing. So thank you very much for listening. I appreciate you listening. This is Brian Gibbons with REI Skills.